When a stock falls 26% in 6 months, most people do not ask the right question. They ask whether the dream is over. That is the wrong question. The right question is whether the price fell because the engine is breaking or because frightened people are dumping the ticket while the engine is still getting stronger. That distinction is where fortunes are made. And if you do not understand it, you will spend your whole investing life confusing turbulence for a crash. I have seen this too many times to be sentimental about it. A stock runs hard for years. New investors arrive late because the past performance finally gave them emotional permission. Then the first sharp decline comes, the headlines darken. A famous bear appears out of the fog. The crowd begins using words like bubble, deflation, disruption, end of the story. People who felt like geniuses 3 months ago now feel like victims. They do what frightened people always do. They stare at the red screen and ask the market to tell them what the business is worth. That is backwards. The market is not there to tell you what a business is worth in moments like that. The market is there to test whether you know the difference between a quote and a company. That is the whole subject. And that is exactly why I want to talk to you about Palantir. Not because I enjoy defending popular stocks. I usually do not. And not because I think every company that falls becomes cheap. Many do not. I want to talk about Palantir because it gives you a beautiful case study in one of the most important patterns in investing. A falling stock price paired with a rising business engine. Most people are not equipped to handle that setup. They can handle a rising stock and a rising business because that flatters them. They can even handle a falling stock and a falling business because the story is simple and the fear feels justified. What they cannot handle is the split. The price goes down, the business gets stronger. Now they are forced to think. And that is precisely where the crowd usually breaks. That is the first rule. A stock chart is not a verdict. It is an invitation to investigate whether price and business are moving together or separating. Palantir has been in one of those separations. The stock is down hard over recent months, down enough to make traders nervous, recent buyers miserable, and critics louder than usual. If you zoom out, long-term holders are still sitting on extraordinary gains, but that does not help the person watching a favorite position bleed in real time. Pain always shrinks the time horizon. A man up 500% in 5 years can still behave stupidly if the last month hurts badly enough. That is why I always tell people to start with the same question whenever a stock breaks down. Is the drop company related? That question sounds too simple to be useful. It is not. It is the difference between investing and reacting. If the company is actually deteriorating, then a falling stock may be warning you about a weakening engine. If the company is healthy or improving, while the stock falls because of broader panic, rotation, valuation compression, or some popular bear thesis spreading through a nervous market, then the decline may be giving you a different gift entirely, a cheaper claim on a stronger business. Those are not the same situation, and if you cannot tell them apart, you will keep selling the wrong things and buying the wrong stories. Now let me give you the mother line for this whole analysis. Price is the label. Business is the engine. Everything we are about to discuss hangs on that distinction. A label can change in an afternoon. An engine does not. An engine changes slower, deeper, and more honestly. The market can mark down the label because of war, fear, rates, an article, a reputation, a sell-off in AI, a hedge fund rotation, a short-term crowd panic, or a famous man's name being attached to a negative thesis. None of that automatically means the engine has lost horsepower. That is why I like this setup so much as a teaching case, because one of the loudest recent concerns around Palantir has been that it is somehow getting replaced, disrupted, or made unnecessary by the rise of general-purpose AI systems, with Anthropic often used as the symbolic rival in the story. I understand why that sounds persuasive to people who only know the headlines. It is not persuasive to me for the same reason I would never mistake a toothbrush for a painting company. You can paint a house with a toothbrush. In theory, you can also cut a steak with a hotel keycard if you are desperate and stubborn enough. The question is not whether something can technically be done. The question is whether it scales, whether it integrates, whether it is repeatable, whether it is operationally sane, whether it reduces friction for institutions whose problems are messy, multi-layered, regulated, high stakes, and deeply embedded in real workflows. That is where the whole comparison begins to wobble. I call this the toothbrush illusion. The toothbrush illusion is when people mistake a tool's broad capability for a full substitute for a scaled, specialized operating system built to solve institutional complexity. A general AI model can answer questions, summarize, generate, assist, draft, reason, and do many remarkable things. That does not mean it automatically becomes the integrated nerve system for governments, militaries, intelligence workflows, enterprise operations, compliance, heavy environments, and layered decision systems that require security, structure, deployment, accountability, and durable process management. People who do not understand institutions always underestimate integration. They think if two technologies overlap at the surface, one kills the other. That is not how serious enterprise software works. Enterprise software survives on embedding, trust, workflow depth, switching cost, and institutional pain avoided. This is why I am very careful when a bear case depends on a dramatic substitution story. Sometimes dramatic substitution stories are true. More often they are emotionally satisfying simplifications of a much messier reality. The real world is full of crude, old, ugly, deeply integrated systems that should have died years ago but remain alive because replacing them is difficult, expensive, risky, and organizationally painful. A product serving that world does not disappear because a sleek new tool arrived and impressed smart people on social media. So if I hear a substitution thesis, I want to see evidence in the engine. That means I want to see revenue growth slowing hard. I want to see margins compressing. I want to see customers leaving. I want to see the balance sheet weakening. I want to see cash generation wobbling. I want to see key executives fleeing. I want to see guidance softening. I want to see actual fingerprints of disruption inside the business, not just a clever article. That is the second rule. If the bear thesis is real, the engine will eventually confess. Now let us look at the engine, and this is where the whole conversation gets very interesting. If Palantir were truly being hollowed out, the numbers should not look like what they look like. They should look tired. Instead, they look alive, more than alive. They look like a company still climbing through a very profitable scaling phase. Revenue growth remains strong. Operating margin has not collapsed. It has expanded. Free cash flow is not struggling. It is growing. Assets are growing. Cash is abundant. Debt is almost comically small relative to the cash on hand. The trend lines, if you actually bothered to look at them instead of borrowing your opinion from someone else. Article title: Do not describe a business being dismantled. They describe a business becoming more efficient while it grows. That matters because when margins expand while revenue expands, you are not looking at a company fighting for breath. You are looking at a company proving that scale is working. I call this the scaling proof. The scaling proof is when a company's revenue growth is matched or exceeded by the rate at which profitability improves, showing that growth is not being purchased through self-destruction, but is actually strengthening the economic engine. Any fool can buy revenue for a while if he is willing to torch enough margin. What impresses me is when the company grows and the unit economics get cleaner, not dirtier. That is harder, and it deserves more respect. If operating profit is surging faster than sales, that tells me something important. The company is not merely getting larger, it is becoming structurally more efficient. It is learning how to convert additional revenue into disproportionately greater economic output. That is not what disruption looks like. That is what dominance often looks like in the middle innings. The same goes for cash. I pay enormous attention to free cash flow because it is one of the cleanest reality checks in finance. Stories can flatter earnings for a while. Accounting can adjust, defer, smooth, explain, frame, and decorate. Free cash flow is less romantic. It tells you whether the business is actually producing surplus cash after doing what it needs to do. When free cash flow is large and growing fast, I get interested. When it is growing, while the market tells me the company is somehow being overtaken, I get even more interested. That is the third mechanism. I call it the cash truth mechanism. The cash truth mechanism reminds you that in the long run, a business survives criticism, narratives, and volatile labels by generating real cash. If the cash engine is strengthening, you should be very careful about accepting theatrical stories of collapse too quickly. Now let us talk about the balance sheet, because this part is so powerful that people almost ignore it. A company sitting on billions in cash with relatively tiny debt is not a company in obvious distress. It is a company with options. Options matter more than people think. Cash-rich companies can absorb mistakes, recruit talent, withstand slowdowns, invest through bad weather, survive market tantrums, buy time, and refuse humiliating terms. A weak company under attack becomes vulnerable because it needs rescue or perfect execution. A strong company under attack can simply remain standing while critics tire themselves out. That is a very different posture. I call this the fortress effect. The fortress effect is what happens when a balance sheet becomes so overbuilt relative to liabilities that the company's survival and flexibility stop being a meaningful part of the bear case. The critics may still argue valuation, they may still argue competition, they may still argue hype. But they cannot credibly argue that the company is one bad quarter away from a financial emergency that matters enormously. A lot of bad investments are bad, not because the idea was wrong, but because the company did not have the financial stamina to survive the period before the idea got tested. A fortress balance sheet buys time. Time is one of the most valuable hidden assets in business because the market is full of impatient people making short-duration judgments about long-duration companies. Now let us turn to the thing most people ignore, even though it is often sitting right in front of them. Institutional behavior. I always tell people the same thing. Do not obsess over what institutions say in public. Watch what they are willing to hold with custody. Public language is cheap. Custody is expensive. If the biggest asset managers, the Vanguards, the Fidelities, the large institutional holders are steadily increasing exposure over long stretches while the commentary machine keeps warning retail away, that is telling you something. It may not mean the stock is cheap tomorrow morning. It does mean that smart capital is willing to keep attaching itself to the business while the public argument remains noisy. That is worth noticing. This is the fourth mechanism. I call it the custody gap. The custody gap is what appears when public discourse sounds far more skeptical than the behavior of long-duration institutional capital when that gap opens. One of two things is usually true. Either the institutions are badly wrong in a very broad and persistent way, or the public narrative is shallower than it sounds. I do not assume institutions are infallible. They are not. But I do assume custody reveals conviction more honestly than opinion pieces do. And conviction is where the money is made. Now I know what some people are thinking. They are thinking, all of this may be true, but what about valuation? Good. That is the right objection. I have no patience for people who think fundamentals alone excuse any price. The greatest company in the world can still be a poor investment if you pay a ridiculous number for it. Price matters. It always matters. It is the only thing you can truly control at the moment of purchase. But here again, people often ask the wrong question. They ask whether a stock is overvalued as though valuation were a fixed label rather than a range tied to growth durability. Margin expansion, balance sheet quality, operating leverage, market size, execution credibility, and time horizon. Great businesses often look expensive to people who are secretly using weak company frameworks to judge them. This does not mean all expensive-looking stocks are bargains. It means you must know what kind of animal you are looking at. If I see a business with mediocre economics trading like perfection, I stay away. If I see a business with exceptional economics, fortress liquidity, expanding margins, rising free cash flow, elite talent retention, continuing recruitment strength, improving returns on capital, and a market that is still letting me buy it cheaper because the crowd fell in love with a scary narrative, then my thinking changes. Now I am interested. That is where the fifth mechanism comes in. I call it the price busyness divergence. Price busyness divergence is when the market marks down the stock while the underlying business continues to improve in the core ways that actually matter: growth, margins, cash generation, balance sheet strength, returns, and strategic positioning. When that divergence becomes real long-term investors are often being handed the exact kind of setup they claim to want, but emotionally hate when it appears. That is the irony. Everyone says they want discounts. Almost nobody enjoys what discounts feel like in real time. A genuine discount usually arrives wrapped in fear. If the world felt calm, the discount would not exist. That is why I do not blame recent investors for being nervous. Red screens sting. Contrarian thinking is easy on paper and expensive in the stomach, but this is exactly why you build a framework before the volatility arrives, so that when the stock is down and the narrative turns sour, you are not asking the market how to feel. You are asking the engine what is true. This is the sixth rule. When price and business disagree, your framework matters more than your feelings. I want to give you that framework. Now, when a stock like this drops hard, I ask 5 questions in order. First, is the decline market related or company related? Second, if it is company related, where exactly is the damage showing up in the engine? Third, are revenue, margins, cash flow, and balance sheet getting weaker or stronger? Fourth, is the bear case showing up in hard numbers or mostly in persuasive storytelling? Fifth, if the business is stronger but the label is cheaper, what exactly am I being punished for buying? That last question is very useful because sometimes the answer is nothing but public fear, and that can be a profitable answer. Now let me talk about Michael Burry for a moment because people become very emotional when a famous bear says something sharp. I do not care about famous bears any more than I care about famous bulls. A reputation does not make arithmetic obsolete. In fact, I want criticism to exist. I want it to be loud. I want it to be serious. I want it to be respectable. A world where nobody critiques your thesis is a world where you eventually get lazy, tribal, and stupid. I have no interest in living inside an echo chamber. That is not investing. That is theology. So I welcome the criticism. But welcoming criticism does not mean outsourcing judgment to criticism. A strong bear case is useful only if it forces you back into the numbers. If the numbers then confirm the bear, you leave. If the numbers contradict the bear, then the criticism may have done you a favor. It may have pushed the price lower while leaving the business stronger than the market now assumes. That is one of the most beautiful situations in investing. A famous critic creating a cheaper cost basis for long-duration owners while the engine keeps gaining power. That is the 6th mechanism. I call it adversarial assistance. Adversarial assistance is when a respected critic or negative narrative helps push down the stock price of a business whose fundamentals remain intact or improve, thereby giving patient buyers better entry points without damaging the engine itself. I enjoy that setup very much, not because I enjoy conflict, because I enjoy discounts created by misplaced fear. This is why I think so many people miss the point of long-term investing. They want the long-term returns without the long-term discomfort. That is impossible. Long-term investing is not merely buying and waiting. It is buying, investigating, holding, tolerating, and adding during periods when the market offers you emotional pain in exchange for future return. If you cannot do that, then you are not really a long-term investor. You are just a short-term worrier who hopes time will save you. That is not enough. You need conviction, and conviction is not a personality trait. It is built from repeated contact with the fundamentals. It is built by studying the engine until red screens stop hypnotizing you. It is built by understanding what would actually break the thesis, so that you can distinguish a falling label from a failing company. That is the identity shift in the whole story, from chart watcher to engine auditor. That is the flip. A chart watcher lives on emotion, momentum, and public tone. An engine auditor lives on evidence, margins, cash flow, balance sheet, hiring quality, return on capital, and strategic depth. A chart watcher panics because the label fell. An engine auditor asks whether the engine coughed. A chart watcher wants reassurance. An engine auditor wants proof. And over enough years, proof beats reassurance every time. Now let me say something very important. This does not mean buy blindly. It does not mean average down forever. It does not mean every drop is a gift. That kind of slogan thinking destroys people. The right lesson is narrower and more serious. If the engine is improving while the label falls, then a lower price may be a better bargain. If the engine starts weakening in the exact ways the bear case predicted, then you respect the evidence and rethink the position. This is not religion. This is disciplined ownership. And discipline is what most people lack when they claim they are investors. They really mean they are hopeful. Hopeful is not enough. You need process, you need numbers, you need structure, you need to know whether the company is becoming more profitable, more liquid, more embedded, more productive, more dominant, more cash generative, more scalable. If the answer to those questions remains yes, while the market is acting as though the opposite is happening, then you may have one of the best asymmetries in the whole business. A better company, a cheaper label, a louder bear, a more frightened market. That combination does not arrive every day. And when it does, it usually does not feel like good news. That is why so few people take advantage of it. Let me leave you with the question that matters. Are you investing in a stock price or are you investing in an engine? If you are investing in a stock price, then this kind of drawdown will always feel like disaster. If you are investing in an engine, then the only thing that really matters is whether the engine is still strengthening, still scaling, still throwing off cash, still fortress-backed, still recruiting talent, still keeping customers, still compounding operating power. That is what I care about. And that is why I am far less interested in whether Palantir is down 14% in a month than I am in whether the business underneath that label is stronger than it was when the label was higher. If the answer is yes, then the crowd may be doing exactly what crowds always do, selling the label while ignoring the engine. And if that is true, then I know exactly where I would rather stand. Not with the chart watchers, with the engine auditors, because that is where the money gets made.